Hello, and a very warm welcome to all of you. My name is Gokul, and I am working as an assistant professor in the Department of MBA in Muthukumaran Institute of Technology. This is our first session in the subject accounting for decision making, and the subject code is MB 25101, regulations for 2025. Today, we are kicking off Unit 1, Introduction to Financial Accounting and Reporting. Whether you are completely new to accounting or looking to strengthen your fundamentals, this session is designed to give you a clear and structured start. So let's begin this exciting journey into the world of numbers, statements, and business insights together. Let's start with the meaning of accounting as defined by the American Institute of Certified Public Accountants. They defined accounting as the art of recording, classifying, and summarizing in a significant manner and in terms of money, transactions, and events which are in part at least of financial character and interpreting the results thereof. In simple terms, this means accounting is recording, which means writing down financial transaction. Classifying means organizing them into categories like income, expense, assets, and liabilities. Summarizing, preparing financial statement like the balance sheet and the income statement. And finally, interpreting, which means analyzing what these numbers mean for the business. It's not just maths, it's an art that turns raw numbers into meaningful business insights. As we start, it's important to know what makes accounting unique. These are the features of accounting. First, accounting deals only with monetary transactions, things we can express in terms of money. It has historical nature, meaning it records what has already happened. It's often a legal requirement for the businesses. The reports are prepared for external use by people like investors or banks. Its main goal are the disclosure of financial status and providing interim reports regularly to show how the business is doing. Uh, Next, scope of accounting. So, where is accounting used? Its scope is vast. It aids in business forecasting and ensures correct taxation. It's crucial for analyzing the performance of a business and serves as documentary evidence in legal matters. It helps in preventing and detecting frauds, supports proper decision making, and acts as a system for replacing memory. It's essential for analyzing the financial status, helping in realization of debts, and is fundamentally helpful to management in running the company. Next, functions of financial accounting. Financial accounting is not random, it's a systematic process. Think of it as a workflow. It starts with identifying relevant financial transaction. Then we record them into journals. Next, we measure their value in money. After that, we classify them into categories like assets or expenses. Then we summarize them into key reports like the balance sheet. We then analyze this data to spot trends. Finally, we interpret the results to understand the company's health and help stakeholders make decisions. This is the divisions of accounting. It's financial accounting, cost accounting, management accounting. These three will be elaborated in the further units. You will see all these three types of accounting in the next units. Then you can see the uses of financial accountings have given some many points. Financial accounting, ascertaining the operation of profit or loss, ascertaining the financial position of the business, keeping systematic records, protecting and controlling business properties, planning and control operation, evidence in court in case of disputes, substitute of memory, comparative study, sale of business, the amount, size, and costs of increase or decrease of capital. These are the various uses of financial accounting. Next, the uses of accounting informations internal. Actually, accounting information will be used in two types, two ways. One for the internal and another one for the external. Internal means the owners, management, and employees will use the accounting information. Owners means they are providing funds for the operation of your businesses. Uh, Interested in knowing how profitability the business operation have been carried out and how the capital is deployed in the form of assets and liabilities. They can they can came to the conclusion only by seeing the accounting information provided by the company. And then management, as the management is answerable to the owners, they need up to date information which helps them in various facts of management like planning, decision making, and controlling. And then employees, they need the accounting information to analyze the uh, to analyze which firm they are serving, and how the bonus and incentives should be paid to them. Likewise, they will analyze by using the accounting information. And then these are the external accounting information points. First one is prospective investors. They are the potential investors. By reviewing the past and present performance of the business, they decide to invest in the money, which means, for example, I am going to invest in one company means I will see their accounting informations like they are doing the business, or what type of business they are doing, whether they are paying the loan amount in ca- regularly, or they are earning profit, they are earning loss. Likewise, I will see, and then we will decide something, and okay, we can invest this much amount in this company. Likewise, we will decide. So we for that accounting information is used. And then creditors, included supply of goods and services on credit and other lending money. Their welfare is closely related to the progress of the business, as they can analyze the paying of capacity of the business. And then government, it needs the information for taxation and other purpose like sales tax, income tax, etc. And then consumers, to analyze the exercise better control over cost of production, and this in turn improves the image and reputations of the business. And then finally, research scholars. Many research scholars or PG students are doing the internship in the company means they will do some project based upon that company by using the accounting information. So to analyze the financial operation of the company, this accounting information is used by the research scholars. Now, what are all the advantages of accounting we can see here? The functions of financial, from the functions of financial accounting, we see its office systematic and organized record keeping, no reliance on memory, and financial clarity, clear picture of income, expenses, assets, and liability, and legal and statutory compliance meets regulatory and tax requirements. Basis for financial statements enables preparation of balance sheet, income statement, etc. And performance evaluation helps compare actual results with the targets. And then finally, fraud prevention, internal controls, and auditing becomes possible. These are the various advantages I have shown here. And then limitations of financial accounting. These are the limitations, which means disadvantages. In financial accounting also there are many disadvantages. Major 7 points I have given here. It records only monetary transaction. Monetary means only money transaction. Other than money transaction, nothing will be mentioned in the financial accounting, or nothing will be used in the financial accounting. Then effects of price level accounting is not considered. No realistic information due to concepts and conventions followed. Personal bias of accountant affects the accounting statement. Permits alternative treatment, lack of uniformity in accounting principle. It's historical in nature because it records only the past transaction and no guidance for the future, or no guidance regarding what we are going to do in the future. Does not record the effect of various government regulations. These are the limitations of the financial accounting. And then GAAP convention and concepts. GAAP means generally accepted accounting principle, incorporated the consensus at a particular time. Uh, as to which economic resources and obligations should be recorded as asset and liabilities by financial accounting, which changes in assets and liabilities should be recorded. Next, accounting concepts based upon the GAAP, accounting concepts and conventions. These are the various accounting concepts. To maintain consistency and fairness, accounting follows certain core concepts. The first one is separate entity concept. The business is separate from its owners. And second is going concern concept. We assume the business will continue for a long time. Third, money measurement concept. Money measurement concept is only transaction measurable in money or recorded. And accounting period concept, we divide business like into periods like a financial year. Financial year means April to March. That's the financial year, accounting financial year. And then cost concept. Assets are recorded at the original purchase cost. Next, dual aspect concept. Every transaction has two sides, debit and credit. Matching concept means expenses should be matched with revenues they help generate. Last, accrual concept, record income and expenses when they occur, not when cash changes hands. Next, we can see the accounting convention. Uh, Besides concept, we have accounting convention. These are the generally accepted practices. Consistency. Once you choose a method, stick to it for the comparability. Second, conservatism. Anticipate no profit, but provide for all possible losses. And third, materiality only include information that could influence decision. And fourth, full disclosure. Reveal all important information in the financial statement. Next, we can see the accounting cycle. Um, the accounting cycle is the complete process from recording a transaction to uh, preparing final accounts. It includes journalizing, posting to ledger, preparing trial balance, and finally creating financial statement, which means final accounts, trading P&L and balance sheet like that. The rules of accounting, especially the golden rules of debit and credit, guide how we record each transaction accurately. Uh, Next, we can see the accounting process, identification of transaction, uh, identification of transaction, preparation of business documents, recording of transaction in journal. That's what I have said. First, we have to prepare the journal and then ledger and then trial balance and then final accounts. That final accounts only profit and loss account and balance sheet. Profit and loss account, trading and profit and loss account, and then finally balance sheet. This is the final accounts. And next we can move on to the golden rules of accounting. And by using these golden rules only, uh, we will uh, we will put the journal. After the journal only, ledger, trial balance like that. It will be generated. Actually, golden rules. There are three types of golden rules. One is personal, and another one is real, and another one is nominal. Personal means debit the receiver, credit the giver. Real means what comes in debit, what goes out credit. Now, in case of nominal, expenses and losses will comes under debit, and income and gain, which means profit, will comes under the credit. This is the golden rule. Depends upon this golden rules only we put the journal. Uh, for for every these three types, we can see what are all the expenses, what all the income you have to take or consider under the personal or consider under the real or under the nominal. I have mentioned here. Personal account means the elements or accounts which represents persons and organization. Under that, I have given some examples also. Real account. The elements are accounts which represents tangible or intangible assets or helps the organization to earn profit. And last, nominal account. The elements are accounts which represent expenses, losses, incomes, gains. Under that also I have given some examples. Then overview of cost and management accounting. We can see the meaning of cost accounting here. Uh, Cost accounting is about tracking cost like material, labor, and overhead. It gives both financial and non-financial information to help manage resource better. This information is used for management decision to control cost and improve efficiency. Financial reporting to value inventory and prepare accurate statement. In short, cost accounting links numbers to daily operations, helping businesses run smarter and stay competitive. This is the meaning of the cost accounting. And then we can look at the management accounting, meaning of the management accounting. Now, let's understand the management accounting. Unlike financial accounting, which is used for external users like investors, financial accounting is mainly prepared for the external users, and management accounting is prepared for the internal inside of the organization, which is mainly for the managers to it measures and reports both financial and non-financial information such as budgets, performance reports, and efficiency metrics. Its main purpose is to help managers make better decisions, whether it's planning, controlling cost, or improving operations, all aimed at achieving the organization's goals. In short, management accounting is forward looking, internal, and decision focused, giving managers the right information to steer the company uh, in the right direction. And next, to objectives of management accounting. The primary objective of management accounting is to enable management to maximize profit or minimize losses. The fundamental objective of management accounting is to provide relevant information to managers for use in planning, controlling, operation, and decision making. And scope of management accounting. Scope of management accounting, there are four scope: financial accounting, uh, cost accounting, statistical method, and operation research. While seeing the scope of management accounting, we can get it to know that based upon the financial accounting only, we will prepare the management accounting, which means that data will be used in the management accounting. Management accounting has a broad scope. It doesn't work alone. It draws from financial accounting for data, uses cost accounting techniques, and even applies statistical methods and operational research to solve business problems and uh, aid in planning and control. And then functions of management accounting. So what does management accounting do? Its key function include planning and forecasting for the future, uh, and modification of data to make it useful for managers, financial analysis and interpretation. It facilitates managerial control, improves communication within the organization, and use of both financial and qualitative information. It plays a big role in coordinating various departments, is helpful in taking strategic decision, and is responsible for supplying information to various levels of management. And then advantages of management accounting. Why is it so important? Its advantages are clear. uh, Increasing efficiency, enabling proper planning, providing measurement of performance, maximizing profitability, helping to improve service to customers, and ensuring effective management control. It's a key tool for the modern businesses. And then disadvantages of management accounting. However, it's not perfect. It has some limitations. It's heavily based on accounting information. So, why? Because if the data is wrong, then the analysis will be wrong. Uh, Management accounting is completely based upon only the analysis. We are analyzing the data for the future prediction. We have to do like this. We have to achieve like that. For that only, managers use the management accounting. It can suffer from lack of knowledge in its application. Sometimes it can't prevent decisions by the managers. It often does not provide alternative to administration. It informs but doesn't decide. Definitely it will be informed, but we can't able to decide at immediately. We can't able to decide. Um, it can lead to a top-heavy structure with too many analysts. Um, it's still in an evolutionary stage, can be influenced by personal bias, and often faces psychological resistance from employees used to old ways. And then journal. This is the first step in the financial accounting. Now let's get into the recording basics. Think of a journal as the diary of the business. A journal entry is the record of single transaction. In double entry bookkeeping, every transaction affects at least two accounts. So we make at least two journal entries. It's the first place where we formally write down a business event. This is the first step of the preparing the statement, financial statement. For preparing the financial statement, this is the first step for the journal. First step is the journal, and you can see the examples I have given here. Journal. Narration is the question, which means we have to write the narration at the end of the every entry. Cash account to capital account, which means capital. First time, if you are starting the business, mean first time if you are investing the money, means that money will be called as a capital account. So cash account to capital account being capital put into the business, and then purchase to cash. Why the cash came to the credit side means the cash was going outside the company. So the cash was came into the credit side. Purchase to cash, which means cash was going outside and the goods was coming inside. Likewise, you have to think and you have to write the journal entry. These are some of the examples I have given. You can go through. And then ledger. After completing the journal only, we will move on to the ledger. If the journal is the diary, the ledger is the summarized addressed book. It's a record keeping system that takes all journal entries and organizes them account by account. You can think of it as a book or a digital database. Interestingly, the term is very popular now is blockchain technology, where it refers to a decentralized, transparent record of transaction like that. Then I have shown I have given some examples for the ledgers also. First, we have put the journal entry, cash to capital, being capital invested, being purchase of furniture, purchase of goods, and then we can move on to the ledger. For every account, we have finally grouped into a single page. This is the ledger: cash account, capital account, furniture account, and we have to balance that. Uh, Depending upon that balance only, we will put the debit balance or credit balance in the trial balance. It affects in the trial balance. So we have to put the uh, we have to total we have to equal the total, so that we where you have to decide where The sum itself will give whether it should be there in the debit side or it should be in the credit side. You have to finalize and you have to write it down. So this balance should be used in the trial balance. These are the examples for the ledger account. For every account, you have to put separately. That's the ledger account. And the next trial balance. After posting to the ledger, we prepare a trial balance. It's a statement that lists all the ledger account balance in debit and credit columns. Its main job is to check the arithmetic accuracy of our books. Do total debits equal total credits, which means debit and credit total should be equally matched. No up and down should be there. Both the total should be same. It's the basis for preparing the final accounts. By using this trial balance only, we will prepare the final accounts. Final accounts means trading P&L account and then balance sheet. I've given the example for the trial balance also. You can see that these are the descriptions, which means particulars, expenses and amounts given. By using the expenses amount, we will separate the debit and credit balance. You can see the total 1,32,000, 1,32,000. For both, the amount should be same. You have to decide whether it will be come under the debit side or credit side. You can see by the ledger balance. By in ledger, you will mention by balance carried on. By balance carried on is there in the credit side means you have to write it in the credit side. Is there in the debit side means you have to write it in the debit side, the amount. That's the uh, trial balance. You, that's the that's the way you will use the ledger balance in the trial balance. And then final accounts. The ultimate objective of this whole process is to prepare final accounts. These are the financial statements like profit and loss account and balance sheet prepared at the end of fiscal year. Fiscal year means financial year. This pur- their purpose is to provide a clear picture of financial position of the organization to owners, management, and other users. This is the format of the trading account. Trading account means only factory related expenses and incomes will be used in the trading account. You can see the stock purchase, sales, everything will be done in the factory. So only factory related expenses and incomes will be used in the trading, and then profit and loss account. That means P&L account. P&L account means general expenses which will be used in the office or other expenses related to the company or other incomes related to the company will be used in the, we have to mention that in the profit and loss account. Debit side will be the expenses and credit side will be the incomes. And then finally balance sheet. Balance sheet is liabilities and assets. Both the liabilities and assets value should be equal. This means they should be tallied. So why I am telling that the both should be tallied means if they are tallied means we can get to know that there are enough amount to settle the debt of the company, which means the if you are doing the business means you will get more debt from other side, from bank or from the shareholders or from creditors. Likewise, you will get more from money from the outside. So but if you are getting the money from outside means you have some enough assets to settle down. So to conclude the financial position of the business, the balance sheet is used. So the both the amount should be tallied. Both the amount is tallied means your business was okay. You can run the business and you can develop something in future, or you can make some changes like that you can do. So for the equal of your debt, equal asset should be there to settle down your debts. That's the major aim of the balance sheet. And the subsidiary books. To manage high volume of similar transaction, we use subsidiary books. These are books of original entry also called day books or special journals. For example, um, all credit sales are recorded in the sales day book. They make recording efficient and help overcome the limitation of recording everything in general journal. And this is the types of subsidiary books. Subsidiary books is divided into two types: cash book and other subsidiary book. Cash book will be single column, double column, triple column, and petty cash book. Petty cash book now mostly most of them are not using. Other subsidiary books means purchase book, sales book, purchase return, sales return, bills receivable, bills paid for every particular important transaction. They will maintain the separate books. That's the subsidiary books, and this is the types of the subsidiary books I have shown here. And then double entry system. Double entry system means in the past many organizations used a single entry system which only record cash transactions, but today almost all businesses use the double entry system which records both cash and credit transaction and follows accrual basis of accounting. What does double entry mean? Uh, every transaction has two sides, a debit and a credit, and both must be recorded. In single entry system, both will not be recorded, but in double entry, both should be recorded. For example, when you buy equipment for cash, your equipment account increases, which means equipment value or equipment quantity will be increased, and your cash account decreases. For if Y means you are spending cash, so cash account will be decreased. This keeps the accounting equation in balance. This system ensures accuracy, completeness, and a clear financial picture, making it the foundation of professional accounting. Next is three column cash book. A special type of book for handling cash and bank is the three column cash book. On each side, um, debit and credit, it has three columns, one for cash, one for bank, and third is to record discounts allowed or received. It combines three records into one for convenience. You can see the format here. Where, debit side, receipt side, which means income side, there is a discount allowed, cash, bank account column, and payment side, credit side, discount received, cash, cash, and bank column. This is the format for the triple column cash book. And then contra entry. Finally, let's understand a contra entry. This is recorded when money moves between cash and bank accounts of the same business, like depositing cash into bank or withdrawing cash from it. The key point is that it does not affect the overall financial position. It's just an internal transfer between two assets we already own. That's wrap up of our first unit introduction to financial accounting and reporting. I have covered the basics from features, functions to journals, ledgers, and financial final accounts. I hope this session gave you a clear foundation. In the next video, we will dive deeper into financial statement and their analysis. If you found this helpful, don't forget to like, share, and subscribe for more content. Feel free to drop your questions in the comments. Thank you for watching and see you in the next class.